All right, hello everybody, and welcome back to another show on the Sharpe Minds podcast. I am your host, Michael Lafata, and today we are joined by my friend Gene Goldman, who's going to spend some time with us and talk us through a whole bunch of the noise within markets and the economy. We're going to dial down on what exactly is taking place within markets and what we could potentially see going forward. So Gene, thank you so much for taking time to be here today. This is going to be real fun.
Thanks for having me.
Of course. Before we dive into things, I actually want to touch on something real quick that was recently reported on and extremely cool. You're recently highlighted as one of the most quoted, as the most quoted CIO in wealth management. And between May 1st, 2024 and May 1st, 2025, your insights were featured in 250 pieces of coverage. So that is so cool and probably an extreme honor, I would assume.
I think it was like 750. So I'm a data guy.
Did I not say that?
Yeah, no, you said 250, which is great. So, but all that matters means is that basically I just talk a lot. So, so hopefully it's quality and not just quantity.
Yeah, no, well, that's my apologies on the on the on the mess up there.
That's okay.
All right, so let me give you an introduction, proper introduction. You certainly deserve it, and we'll sort of dive into things and get rolling, if that sounds good to you.
Sounds great.
All right. So, Gene, you're currently the Chief Investment Officer and Head of the Investment Committee at Cetera Investment Management. With over 25 years of experience in investment strategy and research, you and your team focus on delivering objective economic and market insights, asset allocation strategies, and investment analysis. Prior to Cetera, you notably held market strategist roles at LPL Financial. You are highly recognized thought leader, as we just alluded to, and you're frequently featured on CNBC and Fox Business, just to name a couple. Lastly, I know you're currently based out of Southern California, but as we were just talking about, you are a true New Englander at heart, and you grew up and went to school in Massachusetts. So.
That's perfect. Yeah, perfect. And I think the bio is a little old because I'm older now. It's like 32 years of investment experience. So
Really?
I'm aging fast. And I know you're based in Worcester. I went to school at WPI, Worcester Polytech, studied aerospace engineering, and then I ended up going to Northeastern for grad school. So I'm a New Englander at heart, Red Sox fan, Celtics fan, Patriots fan, of course. So that's not going to change, even though I live here in California. I moved
Yeah.
to California about 14 years ago.
What prompted that move?
Cetera, I think the opportunity here, I think I went from an old firm, had been there for 16 years, had a great run, great insight, great perspectives, but an opportunity arose where I could take over and run an investment team. And as I look back at my sort of mentoring, my last boss at my old firm said to me, back in 2008, he said, "Wow, your job is fine, but we're having a reduction in force. What do you want to do with your career?" And I told him, "I really want to run a research team." And he goes, "You can't take my job. I'm 3 years older than you are. You can't have my job." So he said, "Let's pivot your career to get your experience in about more things that you haven't done as much, like market strategy, like articulation of results." So we focused a lot on that. And then wonderfully, 3 years later, a job opened up at Cetera. Not that I was looking, but it was just a wonderful opportunity. And I got
Yeah.
to move to California.
Yeah.
Oh, and sorry not to interrupt. I talk a lot. I apologize. And the biggest joke when I moved here in August of 2011 was that Whitey Bulger was just caught the month earlier. So everyone, all my friends, all my fraternity brothers, everyone kept coming to me saying, "Wow, are you moving into Whitey Bulger's place?"
Oh, that's funny. Well, you weren't exactly in Southie, were you? You were.
No,
No.
I lived
Yeah.
in down. I mean, before I moved, I
Yeah.
lived in downtown, like South End, Back Bay, those areas in Boston. So
Gotcha. Well, definitely not a bad alternative going to Southern Cal. Definitely could be worse. That's for sure. How'd you make the transition from, your original path going to school, into finance and market research and all that, wonderful stuff?
yeah, for me, I'm half Asian, and my mother is from Thailand, and most Asian children are taught to either be doctors or be engineers or be physicists. So of course, I wanted to be an engineer. I was great at math, and I grew up in Shirley, Mass, which is about half an hour north of Worcester. And basically, I loved math, and I felt like my father was military. He went to Fort Devens. Loved he was in the army. Retired special forces. Great military honor. And I was just interested in the military. And so that's why, math, engineering, airplanes. And I remember one of the things growing up as a child, remember the Lockheed 71A? It was a spy plane. And I remember writing Lockheed to get an autograph of the person who designed the plane, and I forgot his name now. It's been so long, but I got this big, ginormous poster of the SR-71A Blackbird, and he had signed it saying, good luck in your future career. So that's why I wanted to be an engineer, an aerospace engineer. But then what happened is that in 1991, the Cold War ends, and you realize those jobs are not going to really be there as much for aerospace. So I wanted to pivot a little bit.
Mhm.
So I wanted to go in something more finance. And my mother had always subscribed to the Wall Street Journal. I was always interested in finance and data and information. Plus, I'm not a big fan of short sleeve dress shirts or pocket protectors. So I didn't really want to do the engineering route. So I did graduate WPI with an engineering degree, but I ended up going to Northeastern to get my MBA almost immediately.
Gotcha, gotcha. Well, geopolitics is certainly something that we can spend a little time discussing, and all that's going on in the world right now. But the start of the second half of the year is right around the corner. We have a lot of stuff going on within markets. A lot of stuff we can talk about. So much noise, as I alluded to, but going into the second half, you and your team have basically laid out three themes that you think are going to be really prevalent, moving forward through the rest of this year. I'm going to lay out these three, and then we'll dive into each one. The first is we see the economy moderating, referred to as the Great Moderation. You see the Fed cutting less than expected, and you see the return of diversification. Right, that's something that we have started to see this year, and it seems like we could continue to see that. So let's dive into that first topic. We know, I think in aggregate, that the economy is moderating, right? We came off such a streaking hot economy, right, coming out of COVID, all this pent up demand. When you refer to the economy as moderating, or the Great Moderation, as it may be put, what are you referring to? What parts of the economy are moderating, and what are the viewpoints there?
Sure. And it's not just the economy. We call the gray moderation. Everything is moderating. The economy, the labor market, the stock market, the bond market. It's one big moderation. And we call it the great moderation. I mean, you think about the stock market, for example, has had two, in the stock market is the S&P 500, and when I refer to it.
Yep.
It had 2 great years, 2 years of over 25% gains, something we haven't seen since 1998. So stocks are set to come, will be set to be pulled, have a pullback. The economy is slowing down just because we can't keep having significant economic growth, especially with headwinds like higher rates, like slowing consumer spending. We saw, for example, today retail sales came in lower than expected. Data is starting to slow down. So really, the entire economy is starting to slow down a bit. Plus, if you look at job growth for the last, say 5, 6, 7, 8 years, a lot of it's been driven from government hiring. Given what's going on in Washington, we're seeing a lot of that hiring reduced dramatically. So you take all this together, the labor market, you look at the unemployment rate, it's at 4.2%. It was at 3.4% I guess it's not peak, but it's at its low point. We've had a really big move in the unemployment rate. It's not bad. It's not like, some people have lost their jobs, unfortunately, but we're not at the 6 or 7 or 8% that people would be concerned about. We're at 4.2%. And when I learned in grad school, 4.2% unemployment rate is pretty good. So we do think things are moderating, but at the end of the day, jobless claims are coming in around 220 to 240,000 a week. That's okay, not great. You also see quit rates are stable. As if quit rates are declining, that means people are worried about losing their jobs, so they're less likely to quit. And you're seeing layoffs pick up a little bit. But you take all this together, we do think the economy is moderating, but not sinking into any type of deep recession. So that's sort of our basis around the great moderation. It's going to slow down, the economy is going to weaken, but we don't see a recession. In fact, my team and I, if you look at a recession on average in any given year, the chance of a recession is around 20%. We just don't see a recession, at least unless something drastically changes, probably until maybe early 2027, maybe after the midterm elections, but we'll see.
I think that's a great distinction, right, between the economy going into some sort of contraction or recession versus just moderating, right? Like as I alluded to, and you touched on, coming out of COVID, we had all this pent up demand. Everybody wanted to get out and do stuff. a lot of people, a lot of consumers were flush with cash. Savings rates were at pretty high levels, um, and it's not necessarily a bad thing, right? That's slowing down. I think moderating and sort of going back to normal is a great way to put it.
Yeah, and remember, like when you and I went to school, we learned something from our economics professor. So I went to high school in Acton, Boxborough. I was in the area,
Hmm.
and Dr. Winslow Smith was my economist, my economics teacher, and he made a statement that I believed him. We all believed him. He said a recession is when you have two negative quarters of GDP, and we all learned that. This is what we were taught: two negative quarters of GDP. So 2 quarters where the economy goes negative. Goes down. But in reality, remember, we had a recession in 2020, the COVID-led recession that
Hmm.
lasted 2 months. So you think about it, Dr. Winslow Smith was not right. But in reality, what it is, a recession is defined by a group called the NBER. It's a nonprofit think tank,
Hmm.
and they look at 6 key factors to decide, are we headed to a recession? So they look at labor, productivity, manufacturing, a bunch of different factors and stats. And if you look at these stats right now, none of these at all are screaming going towards a recession. None of them. They're all stabilizing. They're all fine. They're all above positive. So at the end of the day, we still don't see a recession anytime soon. Again, as long as things we'll talk about later, like tariffs and so on, don't worsen.
Do you think the shift that we've seen towards a services-based economy has had a big effect on why recessions, or why we haven't seen one yet, and going forward, why they may become less prevalent?
Yeah, I'm not sure. Obviously, a shift towards services that just makes sense because our economy is very
Mhm.
services focused, and we're are trying to manufacture less out of the country. But I think what's more important to think about is the fact that the the percent of income that's being used as transfer payments from the government, that's increasing more than it has before. So whether it's Social Security, whether it's other type of support payments, or whether it's even just your 401k, as people retire, they're taking money out of their 401k. We're seeing a greater percentage of money coming out of these income programs or of these transfer payments. And as a result, there's less economic fluctuations in the data. That's why, you look at, for example, right before COVID, we had the longest expansion in the history of our country. We had the longest stock market, bull market in the history of our country, at, ending at COVID. Long story short, I don't think the fluctuations are going to be as big or as wide as we've seen before. Of course, there'll be these big hits like COVID, for example, like the great financial crisis in 2008. They can happen again. But I think it's being smoothed out a little bit more because the greater reliance on transfer payments and other income solutions as people retire.
Gotcha. Makes total sense. That also could be why, partly why consumer sentiment hasn't been that great, right? Because we have this push now to possibly reduce some of those benefits, and all that stuff is potentially on the table. So that could definitely be contributing towards the low consumer sentiment that we've been experiencing, for the past few months,
Yeah,
or more than that.
and also don't forget, it's also the tariffs and also the other issues too,
Yep.
probably weighing on consumer mind, and then higher potential inflation, which we'll cover later.
Yep. So speaking of inflation, you guys don't see the Fed cutting that much this year. Um,
No.
let's yeah, let's dive into that. I think the market's expecting a couple cuts, but I think you guys are expecting maybe one or even none.
Yeah, it's a contrarian view. So, we mentioned this. Our first theme is a great moderation. Everything is moderating. The second theme that we said is relates to one of our themes from 2024. So in 2024, we said the Fed goes from being a foe to a friend. They go from raising to cutting interest rates. We take this theme a step further for 2025, and the theme is simply this: the Fed proves to not be a good friend. They don't cut rates as much as they said they would. So if you look at what the Fed has said prior to this meeting, the Fed said through their dot plot that they would cut rates twice in 2025. And just for your listeners and your viewers, the dot plot is simply a quarterly statement that the Fed releases that says, anonymously, it indicates what each Fed member believes where inflation will be, the employment picture will be, where the economy will be, where interest rates will be. They do this anonymously. It's a great indication of what the Fed is thinking on a go forward basis. So right now, the Fed has said 2 times for 2025, they'll cut rates twice. But if you think about since the last time they released this dot plot back in March, a lot of things have changed. We've had tariffs, and we'll talk about tariffs, of course. I keep saying that, but we will.
Hmm.
Also, there's the uncertain impact on inflation. And if you remember the Fed has a dual mandate. The Fed does a lot of things, but they have a dual mandate. The dual mandate is simply this. They want to make sure, first of all, we all have jobs, so they keep the economy stable. And second of all, they want to make sure that inflation is kept in check, prices are stable. So, for example, if all of a sudden we start losing our jobs, the Fed, in theory, lowers interest rates, and this causes credit card rates, home equity loan rates, auto rates, all to decline.
Hmm.
And this, in theory, stimulates the economy, and vice versa. If prices are too high, if inflation is too high, they raise rates. This pushes rates higher. This slows down the economy because this reduces demand because it becomes more expensive to borrow. So if you think about the Fed right now, the economy is slowing. It's not going into recession, it's moderating. And there's enough of a reason, enough of a data that the Fed should be cutting rates. Because if you look, an example, the Fed funds rate, this is their primary interest rate tool, it's about 2% over inflation. And if you look historically, that number tends to be a little bit lower, between 1 to 1.5%. So the Fed should be cutting rates because it's impacting the economy. It becomes more expensive to borrow money. But remember, they have a dual mandate. So yes, the economy is slowing, but inflation is still pretty elevated. The Fed has a 2% target for inflation. If you look at some of the most recent readings, they're coming in at like 2.5 or 2.6%. Inflation is headed in the right direction per some of the readings, but it's not close enough for the Fed to even begin cutting rates. And the Fed has no idea what the impact of tariffs will be on inflation. So, long story short, the Fed said twice in their most recent dot plot. And I do believe that they actually may say that we're going to go from cutting two to maybe just one rate cut, because there's been a lot of dissension amongst the voting members, especially in speeches and commentaries and perspectives about the impact of tariffs on the economy and on inflation, that may go down to one. But here's the other important point. The markets have or the Fed has priced in two rate cuts for 2026. So per this whole dot plot, I think they actually just moved some cuts from 2025 into 2026 because, sorry, and I apologize for talking a lot right now, but if you think about this, the Fed has enough incentive to cut rates because the economy is slowing, but they're going to wait as long as they can because they're not sure about the impact on inflation. So what that means is that the Fed is looking to be much more reactive instead of preemptive. Usually they try to be preemptive. So now if they're more reactive, they're waiting longer and longer to cut rates. This increases the risk of a policy error, maybe a recession, maybe something bad happening in the economy, and all of a sudden the Fed will need to play catch up and cut rates dramatically. So that's the next year. That's what the play is for 2026. So long story short, Fed is pricing in two cuts this year, two cuts next year. I may see it being zero or one this year, but next year being a lot more cuts depending on the direction of the economy, because the Fed will prove to be a little bit too late.
Gotcha. So you do think that if we didn't have this whole situation with tariffs going on, um, and some of the other policy, things, that we would be getting more cuts this year. It's basically just delay the process.
Yes, definitely. Because if you remember, tariffs increase inflation, but it's a one-time effect. It
Mhm.
doesn't just keep increasing it. So therefore, there's a big bump up in inflation, and the Fed just doesn't know how long that inflation will last. Will it last for a year? I mean, they just don't know what the longer term impact on inflation was. And remember, the Fed is a little gun shy because of all the mistakes they've made over the last few years, transitory, and we can go through a list of mistakes. So there's enough economic data to suggest the Fed should be cutting rates already, but they can't because they're worried that they'll accelerate the economy and push more inflation into our economy.
Yeah. Let's dive further into this, and then we'll come back to diversification in a little bit. But since we're on this topic, right? Let's dive a little bit further into tariffs and inflation. Why haven't we seen this reflected in the inflation reports yet? Right. I mean, the past couple that we've gotten have just continued to come down. Right. Seems like prices could be moderating. Right. Um, there's a couple things such as shelter and auto insurance, which have been propping up the CPI for most recently. But why haven't we seen these tariffs sort of filter through to these reports yet?
Sure. So let's go back to Liberation Day. Liberation Day was April 2nd, and Liberation Day, I'm gonna go, it's gonna be another long answer, so I
Yep.
apologize. But Liberation Day, President Trump and the administration came out and announced some of the most aggressive tariffs that far exceeded expectations. So this pushed the effective tariff rate up to about, I think it was like 28%. If you took all their um, retaliatory tariffs that the President Trump implemented, and basically it's a 28% effective tariff rate. So just to put that in perspective, that's the highest rate since 1901. That far exceeded even the great the great the Great Depression, where if you think back during the Great Depression, what happened to protect American businesses and American farmers, we raised tariffs on foreign imports. Other countries retaliated, and all of a sudden we had just tariffs and trade wars and going on. And this is the cause, one of the primary causes of the Great Depression back in the early 30s. If you think about tariffs, though, let's just think about this for a second. On average, when a tariff happens, a price a tariff is applied to an imported good. Companies take Sorry about that. Companies take so a tariff is applied to an imported good. Companies take that cost and pass them off to consumers like you and me. So we see higher prices
Hmm.
because prices are moving higher, and therefore this reduces economic demand because all of a sudden you have demand destruction, prices are higher, we don't buy as many other goods. So you have rising prices, you have weakening economic growth, and of course with tariffs in trade, you have uncertain supply chain, all this uncertainty going all over the place. If you think about a good rule of thumb is that about 10% of a tariff will impact our economy. So what that means is that if the effective tariff rate is 27%, in the course of a year, you would see inflation rise by about 1 to 2%. You would see economic growth decrease by about 1 to 2%. That's about that 10% of a tariff level. We haven't seen this yet because what's going on is that when tariffs are first announced, tariffs are deflationary at first. It may be a surprise, but they are deflationary because all of a sudden companies raise prices on goods. Goods become more expensive. They Consumers like you and I buy fewer other goods. This slows down economic demand, and at the same time, because economic demand is slowing down, there's a negative impact. There's an impact on economically sensitive commodities like copper, like oil, like gas, for example, pushes these prices down. So that's why tariffs initially are definitely deflationary, and we're seeing this right now. That's why we haven't seen these in some of these inflation reports. But trust me, we will see a rise in tariffs and inflation due to tariffs, whether it's this next month's CPI or the month afterwards. As long as tariffs stay where they are right now, companies are passing costs on to you and I. Tariffs will increase, inflation. We'll definitely see this. It's taking a little bit longer because tariffs are deflationary at first.
Yeah, it's a similar idea as to what happened with COVID, right? We had a lot of supply chain issues, during the pandemic, and companies passed on a lot of, price increases and issues with supply chains to consumers. And that's the result of a lot of the inflation that we had, back then, which I guess we're still seeing the remnants of, but similar kind of ideology there.
Mhm.
Is there anything else on your radar that you think could, cause inflation to go higher outside of tariffs?
It's a great question. Other thing outside of tariffs, obviously there could be a strong surge in the stock market because if stock markets surge dramatically, all of a sudden there's additional discretionary income and people start to spend more. I think a lot of the spending we've done already, especially services spending coming out of the COVID, good spending. We spent a lot during COVID, like
Mhm.
TVs and radios and refrigerators and so on. But I don't see too many risks right now. I mean, there's always going to be something like maybe the Fed cuts rates too fast, too quickly, and then housing and mortgage rates come down, housing prices increase, people buy houses, have to refurbish houses, but or refurnish houses. But at the end of the day, there's really nothing that can drive inflation right now because the inflation before this COVID, I mean, sorry, before the tariff news was on a downwards trajectory anyway. So I don't see much coming down the pipeline at this point. I
And
mean,
you,
there's always sorry, and there's always like wars, and
yeah.
we talk the Middle East, and there's always like wars, impact oil supply chains and push up prices. That's potentially, but generally, economists tend to discount a lot of those war-led inflation surges.
Yeah, and you mentioned, if we see a drastic rise in the stock market, to sort of answer that question, is that because of something like the wealth effect, where we see more and more people, their wealth continue to increase, they're more likely to spend money, they're more likely to go out and do things, which in turn could possibly raise prices.
Exactly. Obviously, if you look at the income, like income from homes and from stock market, it's a greater percentage than it was just a few decades ago. People are more confident about income, about stock market gains.
Mhm.
This translates into consumer spending.
Yeah, uh, I don't like it when everybody is so confident about how good the markets could do going forward. Um,
Yeah, that's a good point because if you look at our three themes, great moderation, the Fed not cutting rates as much, and diversification, which we can talk about later, diversification being, coming back into play, they all have an air of caution. And that's why coming into 2025, when we laid out these three themes, which
Mhm.
are still valid today, these three themes, they have an air of caution. That's why we weren't surprised by the correction that we had earlier this year. And that was, we also had high valuations, extreme market optimism, and we also had some news in January about the weather being cold. We had the coldest January since 1988, and we had the news from DeepSeek, the Chinese company that came out with a large language model that was cheaper and easier to implement than even the existing ones out there. You take in this puts into the question the concerns around technology sector. You take all these together, we weren't surprised by the correction because these all became huge market headwinds. We were surprised the correction took so long to happen. We didn't have the correction until March, April, and it took a while for us to hit the market.
Yeah, it was an interesting correction too. I mean, and you know, from all-time highs, we were right on the border of correction territory. I think it was 18 and change percent down, but year to date, it was not a big number at all. I think we were still, mid single digits just on, year to date return, which it's just, headlines, all the news, all the stuff really can, it can really drive, market sentiment downwards.
Yeah, and that correction, I mean, as I mentioned, all those headwinds, and then you add on top of the tariff news from the Trump administration, that's when the market sold off stocks dramatically. What what really worried us, yeah, the correction was bad, but what really worried us was a sharp sell-off in the bond market. And the bond market, if you think about the 7 days after the Liberation Day, so that's April 2nd, that's when the tariffs were announced. In those 7 days, the 10-year Treasury yield surged from about 3.99 all the way to 457. And if you go back to Investing 101, and I'll show this as like sort of like with my hands, we learned that there's a simple investing is very simple. You either buy stocks or you buy bonds. Yes, yeah, I know today you can buy other things like crypto and gold and whatever, dollars, whatever. But really, it's really one decision. You buy stocks or you buy bonds. And usually when if you start to sell stocks, stock prices come down, money leaves the stock market and goes into the bond market. So when stocks come down, bond prices go up higher because there's a demand for bonds. This puts upward pressure on treasury prices. So by putting upward pressure on treasury prices, a sell-off in the stock market, because yields are inverse to prices, yields come down too. So with all that said, when stocks sell off, usually bond yields come down. What we saw was something in the exact opposite. On the 7 days after Liberation Day, stocks sold off dramatically and bond yields surged. And that was not usually what happens. And what was going on was that the bond market was potentially breaking. Something was potentially going to fall apart or break. And I know some naysayers out there were saying, oh, that's just the bond market repricing and inflation. I didn't think so, because if you go back to that point, the tips, treasury inflation to protected
Hmm.
bonds and treasuries were about 2% over each other. And that's consistent with the Fed's target. And that week, we also had two really good bond auctions for 10 years and 30-year treasuries. If the bond market was repricing inflation, there would not have been that great demand for these bonds. And we saw a huge demand for both of these bonds. So I think what was happening was something broke. And this is part of the reason why President Trump reversed some of his tariffs or paused some of the tariffs, because that sell off in the bond market really freaked out. I don't know if I can say freaked out in the podcast, but they were really scared the Trump administration, because bond markets don't do that, should not perform that way.
And that's good why it's yeah, that's good why, there's somebody like Scott Besson in there who is extremely familiar with how markets operate and, pays really close attention to it, and all that stuff, so he can stay in, the president's ear and, um, keep him aware of why the market's reacting to certain things and, what it could mean.
Definitely.
What about the health of the consumer? Are we seeing the consumer, like actually being fatigued, or like in aggregate, or is it just parts of the consumer, maybe like the lower end? Um, I know there's a lot of stats out there about how, the top end of the consumer, holds a lot of weight in terms of, GDP growth, all that stuff. But what are you guys seeing in your research when you think about, consumer spending and, overall fatigue and health of consumers?
Yeah, it's a great question. And we've called it a K-shaped recovery in the consumer. So basically, if you think about a K, basically you have the higher part moving higher and the lower part moving lower. I do think um, in the K, we're having a K-shaped recovery where higher income consumers are doing really well because we talked about this before, stock market gains that they're locked into lower interest homes, so their monthly debt is pretty low. Plus, debt to income levels are pretty low. Debt to equity levels are low, and if you look at sort of equity as a percentage of home values, we're at such high levels we haven't seen since like the 1980s. So we have good equity to debt levels within homes. So take all this together. This is protecting the upper end consumers. The lower end consumers are struggling. They're living, unfortunately, paycheck by paycheck. And you can see this in consumer data, especially bank data from the Fed showing delinquencies are increasing pretty fast. Student loan delinquencies are rising.
Mm.
Credit card delinquencies are rising. Everything is rising right now. So we do believe that, that the economy is very bifurcated. There's really the upper end is doing well. The lower end is still struggling, again, with higher oil still, higher energy prices. So if you look for me, my role as a chief investment officer, I'm looking at the entire economy as a whole, but I know that there's pockets of weakness and pockets of strength throughout the economy.
How much further do we need to see the lower end consumer weaken before it becomes like really concerning? Let's say the higher end stays, roughly where they are, but lower end just continues to struggle and that gets worse. Is that going to at some point become really concerning?
It's hard to say because I think it's hard to quantify that because we have to look more importantly at is the employment picture because the labor market is really what drives the economy. So if you see a surge in the unemployment rate, that's a different story. That will be a bigger impact in terms of the economy. Also, if you look at the consumer, obviously consumer lower end consumers are starting to reduce their spending. You're seeing this already. We're not worried about the economy yet because as long as the labor market's strong and as long as wage growth continues to exceed inflation, as we're seeing in the employment picture, things should be okay. But that's something we're watching very carefully.
So, and have we started to see, that slowdown in labor hiring? Is that something that started to come on the radar yet?
Yeah, we're seeing there's every week there's multiple every month actually, and every week there's multiple labor surveys, and you can look at obviously jobless claims, people filing for first time unemployment claims. You can look at ADP reports and the JOLTS report and the payroll report. The data is mixed back and forth, but I think that the data point that we look at is, how many jobs are out there divided by number of people looking for jobs. And right now the ratio is still above one.
Hmm.
So that means there are more jobs out there than people looking for jobs. Yes, there's going to be some skills mismatch on occasion. There's going to be some other factors, but at the end of the day, there's more jobs out there than people looking for jobs. So anyone that wants a job can, in theory, find a job. And even those people that that don't want jobs, even they can find jobs.
Hmm.
And there are jobs out there. So we are seeing layoffs pick up a little bit, and that's just a normal part of our economy. But the overall unemployment rate is still pretty muted at 4.2%. And I think some of the forward-looking data points that we look at, there's an indicator called the ISM, Purchasing Managers Index. So ISM is the Institute of Supply Management. They're a trade group, and they service purchase. I mean, they survey purchasing managers every month, and they're asked a bunch of qualitative questions: how's business, how's hiring, how's firing, and so on and so forth. ISM takes this data, squeezes it together, If it's above 50, it's expansionary. Below 50, it's contractionary. This is such an important data point because it's the first look at the prior month's economy, and the S&P 500 revenues tend to be highly correlated with it. So it's an important index. And if you look at the subcomponents, like prices are surging dramatically. The employment picture is stable, rising a little bit, but still pretty stable. So you're not seeing it diverge either significantly higher or significantly lower. So we take solace in the fact that the labor market is slowing a bit, but not drastically falling.
Gotcha. Yeah, it's something that we've been fortunate to have for the past few years, right? It's we have not had a shortage of job openings, um, and it's just great that that's the type of economy that we've been in, where you can graduate school and basically get a job anywhere. Not at any particular company, but sort of in any field. There's plenty of job openings, and it's definitely something that we shouldn't take for granted. Not sure how much longer that it might be that way.
Yeah, I think the bigger thing though to be worried about is AI. How's AI going to change the job market?
Yep.
And it's something to think about. If you have listeners have kid or listeners or viewers have kids or grandkids, I mean, AI I think is going to change the job environment pretty drastically in terms of what jobs are available, in terms of what jobs you should be focusing on. So
Are you guys, that's a great topic that you brought up. Is AI something that you guys are implementing, with you and your team, the research that you're doing, sort of daily operations? Have you guys embraced that technology yet?
sure. I mean, yes. So if you look at what our investment team does, we really do three things. We provide market perspective, so economic data guidance, like we're talking right now,
Yep.
thoughts on the economy, thoughts on the market. So whether it's in podcast form or whether it's in written or video form. The second thing we do is we provide guidance around how your clients should be invested. How much should they be in growth or value or US or non-US? And then the third area we help is we provide investment recommendations, what to invest in, which specific security. And obviously we do all three of those, and then we also do this for you, so you can just outsource to us. So those are some of the things we do. As you look at all the positions today that we do, a lot of that is very numbers focused and very data focused. And I look at AI, and I think AI is going to complement what we do. Like I always use the phrase, when I'm on TV, I say, listen, AI is like electricity in the 1890s. It's going to be huge. We just don't know how big it's going to be. And I think it's going to be extremely big, even bigger than it is right now. So I make with that in mind, I make sure my analysts and my team, we're not using AI to create research. We're using AI to augment research. So let's say, for example, I get a PDF of an investment, let's say it's like 100 pages long. Olden days, I would just read it, take some time, highlight that, get my trusty yellow highlighter, highlight points, take some notes and comments, put some stickies all over it. Now we have the ability to like put that document into AI, press a few buttons, with the correct prompts, what you want to say correctly in terms of what data you want to get out of it. And it summarizes what you're trying to get out of it in a much easier. Just think about the efficiency. Of course, you have to fact check everything, you have to confirm everything, but using AI to augment your job is definitely going to be very important. So I think that's how we use it. That's how it's going to be used even more and more. A lot of times my friends come up to me and I'll say, hey, they have kids about to go to college and they ask, what should my kids study in school? And for me, I was an engineer, so obviously I would say engineering, but that's not the case. I think there's going to be a lot of jobs out there, computer science, engineering, that may eventually go away because computers will be able to do that information and solve the information, solve those data points faster than we will. And what I tell them instead is those soft language skills, the ability to articulate, communicate, and look at the data and articulate what it's trying to say to you to the end user is going to be much more important. So even like degrees in like sociology, philosophy, psychology, the way to communicate and articulate is going to be much more important than I think actually doing the review of actual data. So
Yeah, it's another great point. Over the past couple of years, we've seen a huge rise in like coding schools for young kids and younger individuals. And like that's not something I did growing up, and it didn't come really prevalent probably until 5 to 7 years ago maybe. But even now, that's changing, right? That's something that I thought I was going to have my kids, definitely learning how to do, but now it's going to become okay. Well, now you got to learn how to interact with AI, all these new technologies that are going to come out of it. and it's going to be a whole new way that we interact with technology.
Right. Yeah, like I hired a consultant to work with my team just to say, okay, here's what we're doing. How do we make it better with AI? And I know Cetera is doing a lot with AI, helping to gauge, data and gauge other perspectives. But for me, this consultant made some really great points. He showed us how to use AI, how to complement our job. But he showed us some really interesting things about AI. Like he took a picture of his refrigerator in
Mhm.
our session, and he showed us, okay, here's a picture, and he says in this AI prompt, here's my refrigerator, here are the ingredients as you see in the picture. Make me a recipe using these ingredients. And it pulled out this amazing recipe for him right there. Another example, he told me the story he was presenting in front of a couple hundred financial advisors. And all of a sudden, his computer goes down, the power goes out, but his phone was working. So he pulls up his phone and he says, "Hey, to his prompt, to AI prompt, he said, I am so and so. I am a chief marketing strategist for this firm. I'm presenting in front of 200 advisors, and my power just went out. What should I do?" And funny, the his phone talked back to him, and AI said, "First of all, take a deep breath. You got
Right,
this."
right.
I love that.
So
But
that's
on the personal, and he also gave me some examples, but how, let's say if you're for you, you, Mike, as an advisor, let's say you're going to meet with a prospect,
Mhm.
you can easily take someone's website, put it in the AI and say, what are some key questions I should ask them for person about their personal business? But, like, and I did this to one of my friends, like one of my friends, she works in Boston on a charity board, and we just tested it out and said, so and so, give me 5 points I should ask this person in my first meeting with her in terms of non-work related, and gave some amazing questions. So I think AI is going to be, we'll be using it more and more. The question is that with investing in AI, everyone's like, oh, buy the semiconductor stocks, buy the big ones. And I can't talk about individual names, but I think the next level, I think that area of semiconductors are starting to slow down because that's usually the first stage in any type of tech bubble, not bubble, any type of tech run. Semiconductors, the next step is applications, how to use it. I think that's going to be the key area next.
and that was, a big theme coming into this year was sort of agentic AI, right? A lot of these, I guess you can think about it as like call centers, right? Service agents, all that sort of stuff. That was a huge theme coming into this year. Me personally, and with all the stuff that I read and watch, I haven't seen much about the evolution of that. So it'll be interesting to see, sort of what the next phase is. But you did touch on, an interesting word there that, I do have a quick question about. So, history would suggest that, this does result in some sort of like stock market bubble, right? Every time we've seen, a revolutionary new technology come, new frontier in some respect, the markets do tend to get a little ahead of themselves. Do you have any sort of thoughts around how um, this could possibly end? Is have you guys started to think about that? And what are sort of your thoughts in that regard?
Sure. I think, and it's a great point. Any type of bubble, you have to analyze it. What causes it? Where are we in the bubble, if it is a bubble? So when we look at a potential investment theme, with any investment theme, you have to look at three factors. You have to look at, first of all, valuations, second of all, fundamentals, and third of all, technicals. And technicals I'll throw it out because technicals don't really work with AI right now. So let's look at fundamentals and valuations. Fundamentals look great for AI. AI, just the ability to use more and more data, because we are in a data revolution. There's so much data being created, and the ability to use like a large language model to take that data and make it in a more usable format. It just has so many different uses. You think about police today, police with their cameras on their uniforms, they can walk around with their cameras on their uniform, capture all their day's activities, go back, and they can drop that into like a tool, and the AI tool go and sort the information, articulate it, and archive it where it needs to be. And think about the time saving of that. That's a huge time saving. So I think AI is going to be more prevalent in what we do. The question of, fundamentals are great. The question is about valuations. Are we pricing in too much good news? And if you think about the DeepSeek company, I mentioned this before, DeepSeek is a Chinese company that created a large language model that was cheaper. And a large language model is like ChatGPT or something like that, or Copilot. They created a large language model cheaper and easier to implement than some of these other companies' large language models. Because of that, now you have to say, okay, if you're that company that spent a lot of money on these big advanced large language models, maybe you don't need that money as much. Maybe you won't get as much revenues or earnings as you thought you would. So maybe you won't spend as much on a go forward basis. This is the concern about maybe valuations are a little bit too high in some of the AI companies,
Mm.
especially in a lot of the especially in a lot of the early stage AIs, like around semiconductors and so on. So how does this end? I mean, I think that there will be, just like with any bubble, there will be winners and losers. We're seeing that again to be sorted. I think there's always usually a trigger point. So if you look at the tech bubble, the trigger point back in like early 2000 was tax bills coming. So a lot of back then, a lot of corporate executives were taking part in the tech bubble. They're getting shares, or they're keeping the shares, saying that, they're getting shares from a company,
Mhm.
and there's a taxable event. Then what they're doing is that instead of paying the taxes, they're just holding on to the shares. And then when the tax bill came due, the shares were worth a lot less. And they didn't have the shares anymore because the value dropped dramatically and they had a big tax bill. You have that combined with some other concerns about companies purchasing each other. And so a lot of things happen in the tech bubble. I'm not sure we'll see the same thing right now, but just have to be very wary. What is the future of AI, and is too much good news being priced in? So watch valuations pretty carefully. Long story short.
Yeah, and that's another one of, the themes that you and your team highlight in terms of, some of the things that are driving the markets today. You guys highlight high valuations, a V-shaped bounce back, which we've seen from the market since it has since recovered, and earnings growth, right? I mean, let's, touch on, each of those. Um, Coming into this year, it seemed as though, the market was sort of priced for perfection, right? Something that we frequently talked about. And, at that point, we didn't really, have tariffs on our mind quite yet. As soon as that happened, as soon as tariffs happened, right, it seems like everybody sort of forgot about, the market being priced for perfection and all this other stuff that we were thinking about. Now we're back to a place where the market's at all-time high, where we mentioned, that V-shaped recovery. Um, talk me through, the thoughts around valuations now, right? Are we in a better spot than we were coming into this year? Um, and what does that mean for, potential returns that we could see going forward?
Sure. So if you lay into so it's set stage for 2025, and we talked about this earlier, but
Mhm.
the last couple of years in the S&P 500, the stock market benchmark, each year it gained over 25%, and that's the first time since 1998. So investors were expecting, you and I were expecting strong market results for another year. But the thing to think about is that there was too much market optimism, despite headwinds increasing, despite uncertainty about the Fed, despite uncertainty about a new administration, just
Mhm.
excitement, uncertainty about this slowing economy. Basically, you had investors ignored all this and they were just buying stocks dramatically, and this pushed up valuations. So at one point earlier in the year, the PE ratio, the price to earnings ratio, and the higher the price to earnings ratio, the more expensive stocks are. On forward earnings was around 22 and a half times forward earnings. That's high. The 10-year average is about 18. The 20-year average is about 16. We saw high market valuations. And high valuations, you can have high valuations, but historically you need low interest rates and low inflation. We had neither. So therefore, valuations were pricing in everything being exactly perfect. But don't forget, as I mentioned before, January, we had the coldest January since 1988. All of a sudden, you had a flu season that was longer than normal. Take that into consideration. Everyone started to fear a recession was coming because economically, weather-sensitive sectors were being dragged down. All this taken together, the valuations were extremely high and the underlying fundamentals were slowing down a bit. Then we had the tariff-induced market sell-off, stocks sold off. We had valuations go from 22 and a half down to about just below 18, pretty fast, pretty quickly. But then valuations have come back, as you mentioned, dramatically. What does worry us about this, is the fact that valuations are fairly close to where they were before. So they're around 21 times forward earnings. Not as high as they were before, but they're still pretty high. Second of all, the bounce back in stocks in this V-shaped recovery has really been on high beta names, like really aggressive companies. And you really want more of a wider market breadth. You want more companies appreciating, not just the aggressive names. So that's a sign of a little bit of frothiness. And third of all, I don't think the market's really factored into the fact that tariffs are here for some time, and the Fed may not cut rates as much as they said. You take all this together, we're not expecting another pullback or a bear market or anything really bad or nasty. But what we are expecting is continued volatility, maybe a smaller pullback. But because there's about $26 trillion of cash on the sideline in money market assets and savings, any pullback we continue to believe will be met with with a strong demand, looking for better valuations. One thing we keep saying is that, stocks with the S&P 500 right now around 6,000, we do believe that stocks at the S&P 500 will be higher at year end than it is right now. Because we do think, yes, there's some near-term uncertainty. But if you look at the second half of the year, you have tariff revenues potentially being recycled back into the economy as tax cuts. We do think more deregulation. We do think potentially lower interest rates late this year, early next year. Stable earnings growth. You talked about earnings growth. Earnings growth this year at the beginning of the year was expected to rise about 11.5% year over year. Now it's expected to rise about 8.5%. But we'll see. It's not down dramatically, but at the end of the day, earnings growth still looks pretty good. And you have the fact that the economy was not as weak as markets had worried about in the first quarter. Yes, it's slowing down, it's moderating, but it's not as bad as it was before.
Yeah, so the V-shaped recovery is something that I think is super interesting, right? It's the past couple market pullbacks that we've seen have been met with fierce buying, right? At some point, and we saw new highs in the markets, relatively shortly after the market bottomed, the past few times. Do you think this is how markets just trade now, right? With how fast, we might price things in because of how fast the markets, trade and operate. Just the general knowledge that retail investors have now, the greater wealth that retail investors have now, the higher incomes that they have now, like all these other things that sort of contribute to it. Do you think, V-shaped recoveries is I guess sort of like the new normal?
Maybe. I do think that we have more data. Data's coming faster. There's more sources of data. I think there's more investment tools and solutions out there. Like now you can buy options like 1 day options. Options are an investment that helps you take part in the appreciation of a stock, but you don't have to buy the stock, you take part in appreciation. You have double leverage and triple leverage stocks and so on. So I think there's more ways to buy investments now. And I think there's more ETFs to buy out there, ways to get into a small slice of the market. I read some stat that there's more ETFs out there now than there are individual stocks, which is mind blowing. So I think there's just more ways to access and get information. The problem is that you always have to look at what's being bought. And I go back to the fact that higher beta, riskier names are being bought in these bounce backs. So I do worry about that, but a little caveat again with that big amount of cash on the sideline. Cash continues to come in looking for better valuations. I think there was I think the Monday after Liberation Day, I forget what that data was. It was probably like April like 8th or 9th or something like that. That Monday after Liberation Day, stock market was down. I think it was down like, over 1,000 points. It was a big sell-off. And then the triple leveraged QQQ, this is not a recommendation, this is just me talking about investment, um, had it's a three-time market bet on the upside for NASDAQ stocks, long story short. This investment, despite the fact that markets were selling off dramatically, has biggest 1 day inflow in the history of the investment. Never had that much. So again, lots of cash on the sideline, I think, is driving some of these big surges and these quick takeoffs in the market. But the last point I'll make is that remember, the stock market tends to price in events about 3 to 6 months in advance. And that's why, maybe with President Trump signaling maybe some thawing of trade retaliatory trades to retaliatory tariffs. This is why the markets bounce back so fast. Because you remember during COVID in February and March, Stocks sold off about 30% really
Mhm.
fast, and they
Mhm.
bounced back really fast, even before we had a recession. And that was the market saying, oh, the Fed will come in, cut rates. So let's price in the better time events 3 to 6 months down the road.
Yeah. No, great points, and certainly it's like a developing story, right? That I think we'll continue to monitor and keep track of. Um, something that we've seen recently take place is tensions in the Middle East have certainly started to rise. Are there any implications for markets? With this, it seems like we're at a point where we'll see de-escalation possibly, but if we don't, right, could there be any negative implications for markets?
Yeah, I think that the unfortunate events, and obviously our thoughts and prayers are those with those
Yeah.
people affected in both regions. The Historically, whenever you have a geopolitical concern like that, something like that, a war or Brexit or something, the stock market tends to be positive pretty quickly. It tends to discount this. Like global flare-ups, these tend to cause short-term market weakness, but they rarely lead to a significant downturn. Here is the case in point. We posted a commentary and a perspective just recently, like last week, and we showed data that the S&P 500 has been positive a year after seven of the last major nine geopolitical events. So the question is, well, okay, what do you do? What should you do? And we've been saying there's three things you have to do. First of all, stay disciplined in your portfolios. If you react to a geopolitical headline that undermines your long-term investment success,
Mhm.
portfolios designed around long-term goals should not be altered hastily due to short-term events. Second of all, stay diversified. Exposure to a broad range of asset classes, sectors, and geographies can reduce portfolio fluctuations. And third of all, just expect volatility, but not a significant dislocation. Uncertainty may increase this week, may increase next week, but we don't expect this conflict to derail the global economy or materially impact long-term corporate fundamentals. So I would stay the course and just be disciplined, be diversified, and expect volatility as a normal part of investing.
The I I I took the data point of 7 out of the last 9 geopolitical events. I grabbed that from your piece and was going to mention that. So thank you for beating me to it. Uh, so you just touched on diversification. Let's round it out and finish with that last theme that we sort of have been delaying. Um, coming into this year, that's something that we've not coming into this year. You know, since the onset of this year, we've started to see international do well. We had periods where bonds have outperformed. You've had value do well. What are the thoughts there? Right, walk us through sort of this theme of diversification is back, and is it here to stay? What are the thoughts there?
Sure. Um, so diversification, just to make sure we're all on the same page, diversification is a strategy where you have exposure to different parts of the market. It's a time-tested strategy. It's classic. Don't put all your eggs in one basket. Have some exposure to different areas of the financial markets, whether it's stocks or bonds or US or non-US. Time-tested strategy. And the goal of it is to reduce volatility. Um, so if you look at the last few years, diversification really hasn't worked because the more you diversify away from Mag 7, technology, AI companies, the worse you did relative to benchmarks because really those are the only areas that did really well. Value underperformed, international, all these different areas. So long story short, the more you diversified, it really didn't work the last few years. Now we're seeing it change a bit. We're seeing, especially with the weaker dollar, making international more attractive when you convert currency, investments back to the US. You're seeing small caps are starting to stabilize, value starting to do okay. So we would be big, big, big proponents of diversification right now. And the key thing, the key takeaway is that definitely be diversified, definitely have exposure to different parts of the market, but don't be too aggressive or don't be too conservative. And you to your long-term objective. And how do you make sure? You have to stay in contact with your financial advisor, stay in contact with Mike and the team at Archstone, just to like to make sure that your portfolios are not too aggressive or not too conservative. That means getting on the phone with them, reaching out to them. There's a change in your financial situation, a new child, a new grandchild, whatever it is. They need to make sure that your portfolios are aligned with your long-term objective because you don't want to be too conservative, nor do
Mhm.
you want to be too aggressive relative to your benchmark, relative to your objective, excuse me.
Yeah, it's a great point, and something for the past couple of years that we've had to fight with is not being diversified. Right, to your point, do you have anything that investors can and listeners can walk away with? For potentially the next period of time that we experience that, where it's like, why do I continue to own international when it's outperformed for or underperformed for the past 10 years? Why do I continue to own value when Mag 7 is driving everything, right? What are some takeaways people can think of to remember during those periods?
Sure, markets go in cycles. So, yes, growth is in favor right now, but there's other cycles go in favor at other times. And plus, if you think about cycles, if you think about other asset classes, everyone loves growth right now, technology and growth and AI, but valuations are pretty high. But if you look at value, valuations are fairly attractive in other parts of the market. The goal is in your diversified portfolio is to combine investments that have low correlations with each other that can help reduce market volatility. The reason we want this is that if you look at the S&P 500 in the last 45 years, it has a positive bias. So in the last 45 years, the stock market has been positive in 37 of the last 45 years. We have a positive bias because we have rising earnings growth, rising economic activity. But in those 45 years, the average intra-year loss is negative 14%. That's the biggest pullback, the biggest sell-off, the biggest downturn in each of those years. Therefore, by avoiding some of those big sharp sell-offs, those volatile time periods, by being diversified, it makes you can help you stay invested for the long term. Because that's the key to investing. Invest for the long term.
Awesome. Thank you, Gene. Did you have fun? How was it?
Good.
Awesome, man. Well, let's finish up with a couple rapid fire questions, then we'll uh, we'll wrap it up shortly after that. What are your favorite sectors for the remainder of 2025?
Our favorite stock market sectors, I would look at financials. I do think financials are over exaggerating the economic and the market, the economic uncertainty. So I do think financials look attractive. Second of all, I would look at technology. I think technology, be selective in technology,
Hmm.
especially on the services side. I do think technology, tariffs are not going to change the services side. Tariffs are not going to change AI. So I think technology is still pretty attractive. And the third area I would look at would be industrials. I do unfortunately believe that geopolitical risks are rising. Defense stocks are an attractive area to take advantage of geopolitical uncertainty.
Do you think we'll continue to see IPOs and capital markets activity increase throughout the remainder of the year?
Yeah, I think so. I think especially as it becomes more apparent that the Fed cuts rates late this year, next year, and given the Trump administration's focus on on more deregulation, more business-friendly environment, I think you'll see more IPOs and more debt issuance.
Awesome. And if you could only have one data point to look at to gauge the current state of the market and the economy, what would that be?
I mentioned before, like I like the ISM. It's the first look at the prior month's economy, the ISM manufacturing and services PMI. But with that said, let me give you a second one. Copper. I think copper is an important data point. Copper, if you look at economic data, it tends to be a little bit backward looking. Like GDP, for example. We won't get second quarter GDP until July 30th. That's like 30 days after quarter end. It's old data. Copper gives you a real-time indicator of how the economy is doing because if you look at the average American car has about 400 pounds, sorry, average American home has about 400 pounds of copper in it, wiring, tubing, and so on. The average American car has about 50 pounds of copper in it. So you take that together, copper is a great real-time indicator of how our economy is doing at any given moment. It's not perfect, but it's a good indicator of where we are in our economy.
Very interesting. You definitely don't hear people talk about that frequently. So it's great to hear something different, unique. One thing I always finish up with is I like to ask our guests, to talk about one moment or thing that they've learned throughout their career that stuck with them. Could be something funny, quirky, could be, something serious and wise. But what is that one thing for you?
Um, I guess the one thing it's a lame answer, but I really believe this. Just have fun. Like I enjoy my job. I enjoy having fun. And I work 12 hours a day
Mhm.
doing something I really want to do and I enjoy myself. So I would always, make sure that you're having fun at your job. The other thing, I guess I'm giving you two answers every time. The other thing to think about, I would definitely do, especially for your listeners and your viewers, is we all don't know everything. And if you hear something about the financial markets, a word, a phrase, anything, Google it, AI it, whatever the verb is for
Yeah.
AI.
Yeah.
Just learn it because one of my old bosses, like this is back in the old days where you take the subway to work or something, you don't hear something, and throughout the day you'll hear 5 or 10 things you just don't know.
Mhm.
At the end, he would say, Google each of those words, those phrases, or those whatever related to financial or data points. Google it, print it out, and read it on the way home. And that's you're always going to learn new things. Like you learn new phrases, new concepts, new ideas, and keep doing that. So.
Yeah, we're gonna have to figure out what that term is for AIing something. We're gonna have to make it sound a little bit better than that, I think. All right. Well, thank you so much, Gene. This has been a real pleasure. Greatly appreciate you taking the time to sit with us here today. As I touched on before, had we're recognized as one of the most quoted CIOs in the industry, and we definitely fully understand why. You have great insights, and you and your team do a great job. So thank you so much.
Thank
Um,
you so much.
you got it. We greatly appreciate it. And thank you so much, everybody, for tuning in. Um, it's a pleasure to continue to do these episodes. So thank you so much for all the support. Please like and subscribe, and provide any feedback that you have. Thank you so much, and we'll see you in the next one.
Sharpe Minds is produced and hosted by Michael LaFata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael LaFata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks LLC and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable, however, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks LLC. Any information provided by them is in no way related to Cetera Advisor Networks LLC or its registered representatives. A diversified portfolio does not assure a profit or protect against loss in a declining market. Asset allocation is an investment strategy that will not guarantee a profit or protect you from a loss. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Cetera does not offer any direct investments, endorsement, or advice as it relates to Bitcoin or any cryptocurrency. This is for information purposes only. Please note, Cetera Advisor Networks LLC is not registered to offer direct investments into commodities or futures. Instead, we provide access to this asset class via mutual funds, exchange-traded funds, ETFs, and the stocks of associated companies. Investments in commodities may be affected by the overall market movements, changes in interest rates, and other factors such as weather, disease, embargoes, and international economic and political developments. Commodities are volatile investments and should form only a small part of a diversified portfolio. An investment in commodities may not be suitable for all investors.